Hi guys, this is Brandon with Simply Lawn Care Services. Today I want to talk about what is a P&L and how do you read the P&L in your service-based business. Just to start off, what is a P&L? A P&L is simply a statement of all the cash and revenue coming into the business and the cash going out. You can think of this as your revenues coming in and your expenses going out. Revenue can be any stream of income. That can be goods sold or that can be services rendered. And then the cash going out, expenses, is any costs that you incur running the business. That's all the profit and loss is. And how you can get to your profit and loss is I'm on QuickBooks here. This is our bookkeeping software. How you get to it is you go up here, you go to reports, and then you go to profit and loss. If you can't find it, you just search it here. Profit and loss. How do you get a P&L? Now, if you do not have a P&L, please, for the love of God, don't try to make it yourself. If you try to make it yourself, you will mess up. I know this from experience. I tried to make it myself and I messed it up bad. The IRS will not like you and your accountant will hate you even more. So please, if you have an accountant, have them set up your P&L and your chart of accounts. Just ask them to do those things. They know what that means. And then if you do not have an accountant and you want a P&L, I want you to go on Google right now, click search accountants near me on Google, and then call 10 accountants. And all of them just say, hi, do you have any availability? I need someone to, one, file my taxes, and two, set up my QuickBooks and my P&L, my chart of accounts. Can you do that? And then just meet with like 5 accountants and pick one you like. Now, they generally will do that for you. Usually they'll do it for free as part of just filing your taxes. So once they set up your P&L and your chart of accounts, you're able to actually start categorizing things and logging them into your P&L. So let's say the accountant taught you how to do all those things, right? So now you have your P&L. So we have some options here, right? This is the top of the P&L sheet. Now we're going to start off with looking at this quarter. And the reason I'm going to do that is we're a seasonal business. So we do landscaping, and because of that, in the first quarter, January, February, March, we do snow removal. Now, if you have a bad season, that can be a negative quarter for you. If you have a good season, it can be positive. For us, it was negative, but I want to start with this quarter because if you're seasonal like us, if you look at this quarter instead of all quarters, you'll have a much better view of the health of your business now versus the entire year. Now, you definitely do want to know the health of your business for the entire year, but because I'm trying to analyze and figure out the performance for right now, how we're doing, I'm just going to look at the quarter. So let's talk about this quarter, and that's April, May, and June. So we're towards the end of June right now, so we're actually almost completely through the quarter. What you can do here is you can see accounting method. There is cash accounting method and accrual accounting method. What cash accounting is you only count the cash that came in or out of your business when you actually had the cash come in. So if you bill a customer, for example, and they have not paid yet, that doesn't count on the P&L under cash accounting because you don't have the cash on hand yet. On accrual, though, if you bill a customer for a job that's completed and you haven't received the cash yet, it does count on accrual in revenue because accrual just means that the work was done and it was billed. It doesn't mean you actually got the money yet. Same thing for expenses going out. That's the difference. I generally recommend use cash accounting. It's the safer of them, especially as a small business. If you have account receivable problems, you really don't want to look at accrual because you could be reporting like a $40,000 profit. But if you're owed $60,000 from customers because you have a bunch of account receivable issues, you're in the negative, but your P&L is going to tell you you're in the positive. So it's going to tell you two different things. So I recommend cash. It's a lot safer and gives you a very accurate number. Now, the last little hack that I like to use whenever I look at my P&L is I like to use the customize feature. And if you go down here to change columns, scroll down to percent of income. So what this is going to do now when I run the report is every expense it's going to give me as a percent of the total income collected. I'm going to run the report and you can see here we are. So this is again quarter 2, April through June. So that it's only the money that came in and out of the business during the months of April and June. And we are using cash accounting. So this doesn't include billed work that hasn't been paid for yet. This is just the money that has hit our bank account and was paid by customers. The three important parts of the P&L that you need to know are, first off, income, right? So this is just the revenue you've generated through your sales or services. This is the money customers paid you for the jobs you did, right? So everyone knows what that is. The second part is costs of goods sold. These are the things that you have to spend money on in order to get the job done, right? We'll circle back to that. But the third thing is just expenses. So this is after COGS. These are expenses that you paid that weren't required to do the job. You didn't need to spend that money to get this job done, and then you get your net income. So let's go through, first off, cost of goods sold. These are the things that you need to spend money on in order to do the work. They are required to do the work. So for example, let's say someone wants us to trim a hedge for $500, right? What do I need to do that job? Well, I need my team members to be paid, right? Because the team member isn't going to do the job if they're not paid. So payroll, as you can see, is included in this. So you have to pay the worker for them to trim the hedge. Secondly, they need fuel, right? You need fuel for the hedge trimmer to work. So that is just a requirement of the job. Fuel expenses. Equipment rental, if you're doing, I don't know, a trenching job, right? And you need to dig a giant trench and you quoted it for it to use a trenching tool that you rented from Home Depot, you need that trenching tool. So equipment rental is part of COGS. You need it to get done. And then same thing with dumping and supplies and material, right? You need to buy supplies for this job if you're laying down weed mesh. It's a requirement. You need to buy the mesh. And then same thing with dump fees. You have to dump it at the end of the job. These are all the things that are required to do the work, right? Now, let's talk about expenses. Like I said before, these are things that are not required in order to do the hedge trimming job. For example, advertising and marketing. Do you need to do website ads in order to get the hedge trimming job done? No, you don't. So these are extra expenses. These are other expenses. And these are things that the business just also does. They call this SGA. That's selling, general, administration. So that's generally sales, general business expenses, admin, office stuff. Advertising is one of the big ones in expenses, SGA. And then what I have here, you can see Brandon's salary. This is actually my salary. And the reason this is separated from COGS, right, is paying me was not required for that hedge trim job to get done. Now, if I was in the field and I was also, for example, doing hedge trim jobs, tree trimming, if I was generating the work myself, technically it's a COGS, but the IRS, they like to separate it. They want to see what the owner of the company made separately. So we separate that. General business expenses, again, it's bank fees, expense payback, memberships, all things not required to do the work, repairs and maintenance, our insurance costs, our legal costs and accounting, team meals, office expenses, internet, owner's payroll tax, rent for the actual building. Because again, remember, you don't need an office or a place to park your trucks to do the hedge trim job. Just things that are nice to have. Scott's salary, he's our general manager. The reason I'm separating the general manager is the general manager isn't directly doing the work. So if he's not out there actually trimming the hedges and mowing the lawns, if he's just helping train people and managing team and running the crews, he is not in COGS. He's not a payroll expense. He is an overhead expense because he's not directly generating revenue for the company. Tools and supplies, trial days, just when we have people try out for a day, damage repairs, miscellaneous, phone services, yada, yada. As you can see, it's just extra stuff on here that wasn't required to do the job. And then if you total all these up, all these expenses, you're going to see at the end of the day, we made $43,000 so far this quarter at a 17.61% profit margin. Again, that's a percentage of the total income. So if you take the 43,000 and if you divide it by the total income, you're going to get your profit margin. So 17.61, that's how it's doing the math there. So now that we've talked about what a P&L is and the big three parts of it, I want to talk about how you read a P&L as a home service business. Now, first off, let's talk about what is a home service business. So we're a landscaping business and we're offering a service to the client. All we're really doing when you boil down a landscaping company is we are telling the client, hey, I will sell you the time of my team members in order to do this work. On the flip side, I'm also selling to my team members, hey, if you give us your time, we are going to give you money in exchange, our hourly rate plus our bonuses. It's a exchange both ways. We're giving them money for time. The customer is giving us money or our team members' time. Why I want you to think that is the biggest expense in any home service business is going to be the pay of your team members. Because again, we're just selling their time in just a more organized fashion. Let's look down here. Now, this is why I always like to have the percentages on. The first thing I always look at when reading a P&L is the payroll wages, taxes, and bonuses. Payroll wage, this is if you're paying your workers $20 an hour, this is that $20 an hour that you're paying them. The next one is payroll tax. This is every time you pay a team member, you must also pay the government for paying the team member. That's payroll tax. So we all know if you've ever been an employee, you get your check, the government takes like 20-30% of it. They take their cut. Well, they do that to the employer too. So the employer also has to pay tax for paying you as well. It goes both ways. That's what this is here. This is a payroll tax. We have to pay the government for paying our team members. And then payroll bonus. We do P for P for our team members. Team members are guaranteed $20 an hour. But if they perform well, we give them a third of their labor revenue. And that's the bonus here. So, and we have some other bonuses, but again, this is something we give for our team members so they can make more than $20 an hour. So what this is showing is that third of every dollar we made just went right back to our team. And if you're in a home service business, you can be paying them anywhere from like 20% up to 40%. That's pretty standard for home service businesses. That's the first thing I'm looking at. One of the red flags you want to look for is if you're in the landscaping industry, you don't want this number to be over 40%. As soon as you're going over 40% of revenue going to the team members, you're probably dealing with some either one, inefficiencies, or two, pricing issues where you're not pricing high enough. That is something I always look for first, is what percentage of the revenue is that you're going to payroll. Fuel expenses, dump fees, these ones are a little harder to control, especially fuel. Dump fees, you have a little more control. You can do things like, for example, you could get a yearly subscription at your dump yard, and maybe they'll say, hey, if you give us like $5,000 for the year, we'll let you dump as much as you want. Things like that can help you control it. And then supplies and material. This is generally around 10%. Again, not something you can really have much control over. You can get a better deal on supplies and whatnot, but it's not a huge deal as long as you're not like massively overpaying. Now, COGS, you can see overall $121,000 of the 245 is cost of goods sold. 49.51%. Pretty good. That means half of every dollar we made went back to just paying for the job getting done. So we had to spend 50 cents just to get the job done for every dollar made. What I'm looking for, green flag, red flag, under 50%, solid, that's in the green. Even 55%, you can get away with that. I'd say that's kind of yellow. If your COGS are over 55%, that's red flag. There's not much profit in the business if your COGS are over 55%. That's what you're kind of aiming for. This is definitely higher for us, but we just finished up the spring rush. And what that means is we pay our workers actually 40% instead of that 33, we give them 40. So their pay is a little higher to account for like new team members, the grass growing really quickly, a lot of inefficiencies. That's why it's higher. Usually this is around like 46, 45% for us. Next up, we are looking at the advertising and marketing. What we aim for is about $1,000 a month in website marketing. That's our goal right now. That's because we're not trying to massively grow, but we are still advertising. And we are 2.5 months through the quarter, so we're basing on that. Exactly $2,500. Vehicle marketing. This is how I categorize the painting of the vehicles. You don't have to do this. Some people do, some people don't. But I like to consider painting of the trucks and lettering them as vehicle marketing. Recruiting, this is for the actual recruiting of team members. So this is money we spend on ads for recruiting team members. And print marketing, this is things like door hangers, yard signs, that sort of thing. Branded salary, again, that's just my salary. You want to get this as low as possible. If you're trying to grow, keep it low. Since I was getting paid under $400 a week for the first 3 years of this company. So the lower you can make this, the better, because it just means more profit for the business and you can focus more on growth. Insurance, this is something you can control sometimes. So as long as if you improve your hiring practices and you become more stringent with like the driving rules and who you're hiring, you can get a better deal. We actually recently did this year. We reduced our insurance premium by about $10,000 per year by switching insurance and getting a package deal where basically we have one insurance handling all three So workers' comp, general liability, driving. And we also, with them, had to agree, we changed our hiring practices where we have much stricter hiring practices. For example, you are required to have at least 3 years of driving experience with us, and you cannot have 2 or more infractions on your driving record in the last 5 years. So very strict, but because of that, we're able to get a premium that's $10,000 cheaper. Now, if you're going to do that, you got to figure out your hiring. So you got to work on your hiring systems and make sure you have enough workers, because it is pretty strict. Building and land rent, really, you don't want this over 3%. Even this, 2.8, still pretty high for me. I'd rather this be around 1 to 2%, but we can grow in this location, which is great. We can definitely still grow the business and make this a lower percentage. So that's all the big highlights of the expenses. So if you're now asking yourself, Brandon, why am I not making any money? There's no profit at the bottom of my P&L. Well, here's what you should look at and what you can do to fix that. Really focus on, if you're just starting out, just focus on what are your COGS? What are the percentages here? These are the things you control. And the down here, these are kind of secondary. Because if you're growing very quickly, these are going to be a lot higher. For example, you might hire an office person even before you need it because you're growing really quick. You might be buying a lot of tools and expenses. You might get land because you know you're going to grow. I always say, don't beat yourself up over these expenses until you have fixed this. Make sure your payroll percentages are correct before you focus on this stuff. And then again, it's very situational. It's contextual. You got to figure out, where am I at in my business? What do I need to do? If you have any questions, feel free to reach out. If you want me to actually analyze your financial statement in a video, I'm happy to do so. Feel free to send it over to me, and I'll let you diagnose it, and I'll tell you the areas you can improve at and what you can work on changing. Thanks for tuning in, guys, and have a great day.